12:30. Welcome everyone to week 2 of a month-long series of events with Kepler. This week we're talking about investing in income. And today I'm really pleased that we've got Tom from BlackRock, who's going to talk to us about the Energy Resources Trust. In 2022, the trust put energy transition as a core theme in its investment strategy, and in 2022 that theme took centre stage, the Russian invasion of Ukraine, and then more recently the US's Inflation Reduction Act has introduced some staggering amounts of capital to be applied to this theme, which Tom will come on to talk about during the course of the presentation. Before I hand over to Tom, just very briefly, Tom will talk for about 30 minutes. During that time, you can put questions in the Q&A box, and I'll do my best to ask those, or at least aggregate those into some sensible derivatives. And we'll have about 15 minutes for questions after the presentation. And with that, I'll hand over to Tom.
Great. Thanks very much, Alan. Thanks everybody for joining. I hope we can keep this as interactive as a typed Q&A session can be at the end. So I'll aim to get through these slides pretty quickly. We had our AGM earlier this week, where we also gave our thoughts. So both myself and Mark Hugh, the co-portfolio manager on this, spoke at length and answered investors' questions there as well. So please feel free to take a look back at that on the Trust's website. So as Alan said in the introductory comments, 2020 we evolved this trust away from 50/50 energy and mining as a reference benchmark to a trust that so we're getting a number of comments that the sound is very bad. I'm trying to see if there is a microphone you can use, but there is not. Maybe Charlie, can you try and dial in on your phone and we can use that instead? So sorry, we'll see if we can get some better audio. It's not flagging an issue in the testing. Is that better? I've now moved it to a different setting. So we want to include the energy transition as part of this portfolio for a couple of reasons. Firstly, we want to reintroduce an element of structural growth on the energy side, where we view the transition to lower carbon forms of energy as a very large structural theme, which is actually going to reignite growth in the mining side, but we want to also reintroduce that element of growth on the energy side, and also just broaden our investment opportunity set, and bring the trust into the 2020s. So we've been doing that for 3 years now, and one thing that the board was very keen that we did when we made this transition was actively manage the allocation between conventional energy transition companies, and mining. And you can see on this slide that hopefully we are adhering to the guidance of that from the board in actively managing the positioning. And if I think about what the changes were during the second half of 2022 and into early 2023, in terms of changes from a top-down perspective, we've been running a significant overweight, if you like, in conventional energy compared to that 30% neutral positioning we've typically been at 35 to 40% for much of 2022. We reduced that back to around 30% in the fourth quarter of the year as physical energy markets loosened. The energy equities materially outperformed the commodity as the oil price fell in the last sort of 4 months of the year. The equities themselves, remained very strong. So we took that opportunity to reduce the energy equities, and also we saw increasing risk that capital expenditure and operating costs would increase in 2023, especially in US shale, relative to where the market's expectations were. And so we trimmed back those energy holdings. Now, we would have been quite happy putting that into cash or parking it into lower risk assets, but actually, as the fourth quarter evolved and China did a 180 on its COVID policy, we redeployed that cash into the mining sector because the COVID policy change in China removed the left tail risk, we thought, in mining commodities and mining equities. And so we rebuilt that overweight in the mining space, with a focus on China-sensitive commodities. Much of 21 and 2022, we had greater sensitivity to some of the commodities like lithium. But the equities there looked like in the middle of 2022 they got overextended in terms of valuation. So again, rotated that exposure towards more China-sensitive metals. This is how the portfolio stood as at the end of February. That energy positioning, bang on 30% there, and with a bias to integrated companies away from E&Ps, where we had greater exposure for much of early 2022. And on the mining side there, you can see split roughly 50% in the diversified and 50% in the more single commodity focused stocks. And then on the energy transition side, the largest exposure on energy efficiency, and then electrification. Within electrification, the utilities feature quite highly there. We're still cautious in terms of the valuation of some of the growthier parts of the market, and that's a perspective that we've taken really for much of the last year. And despite the market turmoil of late, you've not actually seen some of those growthier parts become less expensive. And so we're still quite cautious on some of those growthier parts of the energy transition piece as it stands today. Obviously, the recent market turmoil that we've seen over the last week has been pretty ferocious. We've seen some very big moves in a number of our subsectors. Given disclosure regulations, I'm not allowed to talk about exactly what we've done there. But needless to say, in our view, the turmoil has thrown up the opportunity to add to some of our conviction picks in the energy. So we just seem to have lost some of the high conviction selections in both the energy transition, and the mining space. So we are trying to take advantage of what we see, some really attractive opportunities created by this week's volatility. This just summarises the performance of the financial year in 2022. I won't dwell on because everybody knows that. We've now had 5 years of positive returns for the trust, and the flexibility being able to allocate between those three very different areas, I think has nicely come through in performance. The sources of income is something I want to speak to because this was raised in multiple questions at the AGM. And it's really pleasing to see that over the last 5 years, the percentage of income from options has continued to decline, and the amount of our income that is being generated from dividends, both rules and specials, has continued to improve. We've had some questions at the AGM as to why the dividend hadn't been increased more aggressively, given the rise in NAV of the trust and the increase in income that we've seen. I think it's important to remember that with the current allocation being biased towards energy and mining within the trust, those are the two higher areas of income generation when compared to the energy transition. And so we want to leave ourselves the flexibility to allocate to the energy transition companies, which are higher growth but lower dividend, should we so wish, and not put at risk the current level of dividend. And also on the flexibility to use options tactically rather than have to have options written in a more strategic manner, which was the situation we were faced with, 5 or 6 years ago. So if we move now to touch on some of the themes that are present within the portfolio, and I think it's worth touching upon, some of the longer term drivers of the energy transition. And, sustainable energy or renewable energy, as it's often called, is a narrow subset of what we invest in. It's what often people think about when they think about the energy transition. This has been around for a long time, but, it's only in the last few years that these 3 pillars of regulation, societal pressure, and economics will turn positive. You have had regulatory support for the energy transition for much of the last 20 plus years, but that regulatory support has been accelerating in the last 12 months. That has been driven by what's happened with Russia, Ukraine, and a greater focus on energy security. Part of it is due to a greater urgency around the need to incentivize a move to lower carbon energy from a climate change perspective. We have greater pressure from society, not only to be more sustainable, but also to have an energy transition that is just not and not going to push costs up too hard. This means we're going to have to accelerate rate of investment in renewable capacity to ensure that we don't have energy shortages such that have been experienced during the last 12 months. And on the right-hand side there, economics. You continue to see technology-driven improvements in much of the renewable energy space. Now, the last 12 to 18 months have seen pressures on that. Input costs have increased, and you have seen the rate of change there slow down or even reverse in the short term. That for us has really highlighted an area of investment we've long considered a core part of the energy transition investment universe, which is around energy efficiency. There is a very strong linkage between GDP per capita and energy usage. This linkage or the correlation here needs to be broken. And one way of doing that is through significant investments in energy efficiency, so changing that demand function for energy. Some of the most exciting investments in our portfolio today are around energy efficiency. That relates to sustainability in buildings, or whether it relates to energy efficiency in industrial processes. That is a theme that we think is going to drive outsized growth for these companies within it for the next 5 to 10 years. If we look at some of the regulation that we're seeing, we have seen, in the last few days, more details emerge around the Repower EU and Fit for 55. And I think, probably in terms of what's been a greater focus for the markets, has been what's been enacted in the US with the Inflation Reduction Act, which is an incredibly clear piece of legislation in terms of the way that it provides economic incentives to accelerate change as it relates to lower carbon energy and lower carbon economic activity. And this is something that, when we look at the shape of exposure within the fund, is something that we want to try and get greater exposure to through time. Just to put some numbers around, clean power and what it means, the transition of energy systems is going to result in a significant increase in the electrification of our power systems. We are essentially going to be looking to transition energy usage away from hydrocarbons, whether that's hydrocarbons burnt today for electricity, such as oil and gas and coal, and look to shift those to renewables. But we're also going to have to replace the burning of hydrocarbons in industry and transport by electric power. And that's going to result in significant opportunities in things like the semiconductor industry, but also create significant demand for metals that enable that electrification. And we're going to touch on that later in the presentation. So if we turn to look at conventional energy, which today represents, circa 30% of where the trust's capital is invested, and, the two key things that I want to leave you with here are there's an underinvestment in supply, demand is falling at a slower rate, or will fall at a slower rate than consensus expects. And everyone can remember, economics 101, when demand outpaces supply, you get higher pricing. And this underinvestment in hydrocarbons is something that started to occur 5 or 6 years ago, and has maintained that pace of underinvestment. And we're now seeing that reflected in the lack of spare capacity in the oil industry, which we'll touch upon in a few slides' time. We are not investing enough to maintain productive capacity, and that is something that we don't think will change over the next 3 to 5 years. Oil prices below 100 do not incentivize Western oil companies to set up investment in maintaining existing production, let alone growing new supply. If we look here, this is a series of demand forecasts, based on a number of different climate scenarios, and we think that we're going to see demand fall at a slower rate than the market expects, and that will combine with a supply side that is going to struggle to keep pace, and this is going to keep prices higher for longer. When we look at Europe and the energy markets, we have to touch on this given what's happened over the last 12 months, and it's shown the vulnerability of energy systems to external shocks. And the reason that this winter hasn't been more extreme from an energy price perspective has been because A, we've had mild weather in Europe and the US, and B, China hasn't been pulling on the LNG markets in the way that it would typically do. That's changing. Since China's 180 on COVID policies, China is back in the market. You're seeing economic activity really ramp back up there, and they will come back and pull on the LNG markets. And so this, I think, is going to put additional pressure on European energy markets. We're also seeing existing European energy supplies have risk to the downside. Some of the issues that are facing the French nuclear fleet at the moment with recent announcements. And I think at the moment we're potentially going through a period of slight complacency in European energy markets, and that there is upside risk to European energy prices as we move through the summer and into winter 2023. These charts here just point to the lack of spare capacity in oil markets globally. You've seen the US has been selling down from its strategic petroleum reserve over the last few quarters, and OPEC has a very limited amount of spare capacity at the moment. If we look at the relative valuation of energy companies, you can see that point there that I made around energy equities, holding up quite well in the third quarter of last year and fourth quarter of last year, in the yellow line there, relative to an oil price that retraced from over 100 back to the 80s, sort of $80 a barrel range. And that's the reason why we took that, one of the reasons why we took that energy positioning to a more neutral stance. We touched then briefly on the mining sector. You can see there, really the strong relative performance of mining in the fourth quarter of last year, as COVID pivot occurred, and some of the challenges to the mining space as it drifted lower in the middle of 2022. The boost it received from metal price spikes immediately in the aftermath of the Russian invasion of Ukraine. That period of relative weakness in the middle of 22 also coincided with a stronger US dollar, as that US dollar weakened in the fourth quarter. Also was a tailwind for metals prices, and the mining sector and the trust benefited from that with some of the positioning that we had in both bulk and base metals there. If you look back at what's happened, to iron ore and copper prices, over the last 5 years, if we look at iron ore, first of all, 5 years ago, there were plenty of forecasts of iron ore being a market that would see oversupply and price risks to the downside. What's happened to iron ore markets over the last 5 years is instructive and helpful when we think about what could happen to broader commodity markets in mining and energy over the next 5 years. Iron ore investment and capital expenditure in iron ore has been pulled back since 2015, which means there's very little new supply, and existing production is struggling to deliver what was kind of forecast, 5 or 4 years ago. You've seen disappointments from the Brazilian suppliers and also the Australian suppliers in terms of meeting 2 to 3 year out forecasts. This means that when demand supplies a bit to the upside, you have supply disruption, there's no slack in the system, and prices spike up, as we saw in iron ore in March of 2021. And we think that this is going to be a feature of commodity markets over the next 3 to 5 years, is that as supply is disrupted and or demand surprises to the upside, you're going to have greater right tail price risk than left tail price risk. So more upside risk than downside risk due to the lack of investment and especially on some of the battery materials, very strong demand growth. And when we look at the performance of mining, the mining equities performed very well last year relative to general equities. That's quite different to previous cycles, where we typically expect mining to be correlated with those fears of recession that can drive general equities down. And why did that happen? A couple of really important things. First of all, this mining cycle has been very different. Mining companies have been very hesitant to invest both in new supply and in M&A, which has left mining company balance sheets in a remarkably strong position when compared to previous cycles. You've also got demand today, the growth of which is not necessarily as correlated to economic activity as it has been previously. A lot of the demand growth that we're seeing over the next 5 to 10 years in mining is going to come from the greening or decarbonisation of economic activity, the electrification of grids. We think that this demand is going to be slightly less price sensitive than historic demand has been, and probably less correlated to general levels of economic activity. And this is quite exciting, especially when you marry that with the supply side, which also has a lower price elasticity of supply because of the rising barriers to bringing new supply on, whether that's the lack of discoveries over the last 10 years, the increasing hurdles to permitting and developing a mine, the greater capital discipline of those potential mine developers. All of those are combining to reduce that price elasticity of supply. So you're not seeing a supply response that you would typically see 4 to 7 years into quite strong price cycles for many mining commodities. The charts here just show you some of the growth that we're expecting in copper demand, electric vehicles and renewable energy, for example, on the left-hand side there. To set this in context, the copper market today is around about 24 million tonnes. So you can see that by 2030, we expect EVs and renewables to have really become quite a large component of copper demand growth which is really exciting.
Hi Tom, can I just interrupt you there slightly? We're getting a few technical sound issues here. Ladies and gents, we're just going to improve this slightly. If you can just give us a few minutes and we'll rectify this and be right back. Just apologies, we'll be right back.
Apologies for that. Hopefully the audio has modestly improved. So just to close off then, I think one thing that we've consistently been surprised by, over the last few years is, the general market's lack of recognition that you cannot have an energy transition without the mining sector. And so for us, what has been a series of ESG headwinds to mining over the last decade, we think are going to ease and actually be replaced by tailwinds. I think you can start to see that in some of the recent legislation that recognizes the critical importance of mined material, to the energy transition. One question we often get one question that we often get is, why can't we just move to recycled materials? Well, that would be a fantastic outcome. However, we would all have to take an enormous cut to our standard of living for that to occur. For the energy transition to occur and for economic prosperity to be maintained, let alone grow in both developed and emerging markets, we need new mined material. And that's something I think that is slowly now being accepted and reflected in policy. So with that, I will pause and hand back for questions.
Thanks, Tom. That was great. A few questions coming in of a geopolitical nature, but one more practical investor question is, obviously you have a stablemate with the World Mining Trust. Do you want to talk a little bit about how the two complement each other? Obviously they're operating in adjacent areas, but they're not quite the same thing, are they? Do you want to just talk a little bit about that first?
Yeah, absolutely. So if we maybe go back to one of the slides right at the start in terms of looking at the shape of the portfolio. And if we look at that mining piece, which is, at the end of February was roughly half the NAV of the fund, there are a couple of key distinctions. Firstly, the mining trust is 100% in mining, whereas, for us, we will typically be between 30 to 50%. Within that, the mining trust has consistently held, precious metals within it, and precious metals are part of the benchmark that the mining trust has, or the reference index. Whereas for us, we took precious metals out of the reference index that the board looks at performance against for us when we made the transition, to include energy transition as part of the core of our portfolio in 2020, because gold doesn't have a role directly in energy transition, whereas the other industrial metals all will play a role in helping develop lower carbon solutions across the economy. So that hopefully answers the question there. We would typically expect sort of around about 30 to 40% commonality in holdings.
Yeah, thanks, Tom. There's a couple of kind of related questions here, and maybe topical given yesterday's budget, UK budget. Uranium, and I don't know whether the price would have been in any way affected by the UK government's decision to effectively reclassify. That's not the same thing as building anything, is it? But try to position uranium as sustainable. Does that form part of your strategy? And what's your view on the kind of prospects for the uranium miners?
Yeah, so we own one uranium miner and processor in the portfolio today. Uranium mining is, an industry where the highest quality assets, as defined by the cost curve, today sit in Kazakhstan and are mined with in situ leaching in Kazakhstan. The assets that you can get exposure to in the public markets, either carry essentially SOE risk from Kazakhstan, or there are very few producing uranium companies of size in the public markets. So getting exposure is not straightforward, and often there are more attractive investment opportunities for us, hence us only having one company today, which represents, you see in the charts there, a modest sort of 90 basis points of the trust. I think that understates the role that nuclear will have in a transition to a lower carbon energy system. Nuclear, I think, will provide a very important baseload component of lower carbon grids, and we are excited by what SMRs, so small modular reactors, will be able to do, but equally are cognizant of how long that technology is going to take to become scaled in terms of the number of units rolled out. The first sort of won't be until
and not without putting on the spot to say whether you would literally buy this company. Would a company like Rolls-Royce that will participate in this competition, would that the UK government will be running, would that fall into your universe potentially?
So anything related to the energy transition, we have a very broad definition of what the energy transition is, so we can maximize, the investment opportunity set. That being said, when we look at a business or shares, when we look at the businesses that underlie that, either the majority of the business, so more than 50%, has to be related to, energy transition, or it has to be, the energy transition piece has to be the key driver of earnings or revenue growth for that company on a 3 to 5 year view. So, without directly speaking to any individual issuer, allowed to do that. I hope that answers that sort of question.
Yeah, I think
the way we philosophically approach, looking at exposure.
Yeah, makes sense. And then a kind of perennial question that comes up about energy transition is new technology, and I like to think that lithium-ion batteries were invented in the 1980s and took 20 or more years to be commercialized, and so threat of technology is real, but it doesn't happen overnight. But how do you see that, and do you feel that your kind of commodity-led strategy is a good hedge against that? Ultimately any technology needs commodities, doesn't it?
Yes, I think any one individual technology may succeed or fail, and I think you are less likely to see any one commodity be completely excluded from that mix going forwards. That being said, when you look at the solar industry over the last 20 years, one of its great triumphs has been decreasing its cost per megawatt, and one of the ways it has done that is by being more efficient with commodities such as silver, where the intensity of use has fallen dramatically. So I think whilst we can sit here and say, well, you will always need copper in the energy transition, equally I think you have to be cognizant of human innovation and just how brilliantly innovative companies and individuals can be in thrifting materials. But that typically only occurs when price or availability is threatened. And so we are, I think some way from that in terms of mineral pricing today, in terms of forcing that thrifting behaviour. You have seen the impact, though. However, in terms of demand on the lithium side, prices were up fivefold last year. That will focus the minds of the innovation departments of battery manufacturers. However, in the shorter term, I think what is going to become a greater focus is access to materials, both at a company level and in terms of the consumers of those materials, and from a country level in terms of how strategically important this is going to become. At a company level, you are seeing autos manufacturers sign offtake agreements and financing agreements with mining companies, and in some cases even become shareholders in mines or mining companies. I think that speaks to a very real reality of lack of material availability on a 5+ year view for some of these minerals, and needing security of supply is something that I think is going to become more in focus.
Yeah, great. Thank you. Thanks, Tom. And just turning to slightly more geopolitical matters, clearly 2022 was a big deal for your strategy, for reasons that none of us would really like to have seen happen. But there are more subtle potential risks, aren't there, in that China and Russia have spent a great deal of energy diplomatically and capital-wise in other parts of the world to secure commodities, and you see, it's not universally the case, is it, that countries are condemning Russia, for example, because they're very closely tied to them, and the same is true of China. Do you see any kind of risks emerging from that in the commodities market?
So I think this speaks to what I was just talking about in terms of concerns around security of supply, especially when it comes to downstream processing of materials, of mined materials. China has a very dominant position here across multiple commodities, whether it's lithium, whether it's copper, whether it's rare earths. They, in some instances, like rare earths, have a large proportion of mine production, but they dominate in terms of processing capability. And I think that's something that is going to be on the minds of companies and increasingly governments around the world. From our perspective, how does that influence the way we think about investing capital? When I think about the challenges to building new mines, whether they be permitting, whether they be technical, whether they be personnel, like lack of qualified people, is a big issue for the industry. I think the value of existing production of mined materials, especially the likes of copper and nickel, in lower risk countries, is being underestimated in the market today. And I think that is something that is going to become increasingly apparent over the coming years. But it's one of those things that customers and the market won't worry about until it becomes an issue, and then they'll really worry about it. Like many things we see in markets, you don't see a reflection of probability of risk in prices. You see either no risk priced in, or then the entire risk priced in a day later. And I think you'll see that in terms of some of these supply risks over the coming years in the mineral space.
Yeah. And do you see the I suppose the question is, should we read anything into the very low UK exposure? I mean, this is a global mandate, isn't it? But we're targeting UK investors, and I guess they're interested in the whether we should read anything into that in terms of your view of UK transition policy.
The companies that we own are mostly global in nature. We typically, especially given the income mandate of the fund, have a large cap bias. And when you look at the country of listing, it's really only some of the large energy companies that remain in the UK. And you've seen some of the large global miners such as BHP, redomicile or remove its dual listing structure and focus on Australia. So the low UK exposure today relative to 5 years ago is a reflection of some of those market dynamics more than anything else.
Yeah. Thanks. And then, I mean, BlackRock is a very vocal participant in the ESG debate, and I suppose historically, at least, and probably even today, the sectors you invest in, you could say, are at the sharp end of some of the ESG debates, aren't there? Do you want to talk a little bit about how BlackRock is resourced? It's not just left to you alone, is it, to manage this kind of analysis? Do you want to talk a little bit about the resources you have and how this impacts on your decisions?
Yeah, absolutely. So we have quite a large investment stewardship team who are governance experts, and we work very closely with them around matters to do with ES and G. But I think what's really important to stress here is that ESG is not a separate step in an investment process that has to be thought about at every stage, especially when you're thinking about extractive industries. So this is something I joined BlackRock in 2006. One of the first things that we were looking at was the correlation of health and safety performance and economic performance of mining companies, and we put a lot of pressure through engagement with companies to ensure executive remuneration packages, say in 2010 and 2011, started to reflect health and safety metrics in those remuneration and performance assessments. That is, in my view, very much implementing ESG analysis and ESG risk mitigation in an investment strategy. So for us, ESG is another risk that we would look at a company, the lens we would look at a company through in terms of the way we would also assess financial risk, earnings risk, but also I think increasingly opportunity. So ESG has typically been looked at as risk mitigation, and I think increasingly you're going to see the performance of extractive industry companies, especially around the S element, so the social side, as a competitive advantage for those that do it well, and will be a source of outsized growth opportunities for them. Governments, I think, in the developed in DM and EM are increasingly cognizant of who is going to be operating an asset, and so companies that have a track record of operating assets in an environmentally and socially considerate way, building local supply chains, going above and beyond in terms of local education and healthcare, I think will get preferential treatment when it comes to awarding of new licenses and development opportunities. And so that moves, ESG risks away from risk mitigation to value creation opportunity. And I think that's something that's really exciting. And I think, the way that ESG ratings are done today doesn't reflect the potential positives that a company can bring. It's a negative marking. And I think over the course of the next 3 to 5 years, as data gets better, as companies get better at communicating, greater balance and greater clarity will be brought to this. And I think for those companies in extractives that are good actors, that's going to provide really good opportunities.
Yeah, thanks, Tom. I'm conscious of time. We've come to the end, so it's good to end on a positive note. I know there are one or two other kind of practical questions about dividends and policies and so forth. I would point you in the direction of Kepler's website and, of course, BlackRock's own excellent website, where a lot of that information is very easily accessible. And with that, I thank Tom for today's presentation, and thanks to everyone for for attending, and we'll see you on the next one.
Thanks very much, Alan. And a couple of those questions that we haven't directly addressed were very similar to some questions that were asked at the AGM. So skip to about minute 45 of the recording if it's available, and then hopefully you can hear them addressed there around the dividend policy, around the limited Russian exposure that we had going into the Russia-Ukraine situation. So they're directly addressed in the Q&A with shareholders at the AGM earlier this week.
Perfect. Thanks, everyone.